to quickly review. We are in a merchandising company, and therefore the company first buys the merchandise. Now, in the transaction, it must name the word, you must see the word inventory. Otherwise, they're not purchasing inventory. So if the transaction says, for example, purchased equipment, you do not debit inventory, you debit equipment. Now, can somebody tell me what kind of account is inventory? Is it an asset, liability, or stockholders' equity? Garrett is talking, and you should be a little louder because I cannot hear you.
Is it a liability?
Inventory is an asset. Inventory is resource that the company owns and will provide benefit to them. So that's the definition of an asset. And therefore assets increase by a debit and decrease by a credit. Make sense? So therefore, if we draw a T account, let's see, share screen, whiteboard. Okay, so if we draw a T account for inventory, and I should be a little bit more straight, this is terrible. You guys, please excuse my horrible drawing. So we have inventory T account. It increases by a debit because it's an asset, and decreases by a credit. Now, what would increase inventory? Any purchase of inventory gets debited to inventory account. If we return inventory, it reduces inventory account. Make sense? Mm-hmm. Then what else increases inventory? If we are a buyer pays for freight, the shipping cost. Freight or shipping costs are the same. That will increase your inventory. Now, what decreases inventory is if we receive discount, no, not this, purchase discount. We receive a purchase discount, that will decrease inventory. So far, you guys are okay?
Mm-hmm.
Okay, excellent. So let's see, draw. And this one, can I draw it a little bit more? Oh, good. So what else will affect this? Purchases, returns. Oh, the other thing that will affect this inventory account would be returns and allowances. Remember the difference between return and allowance? Return is we actually return the inventory because it's damaged or we don't want it. Allowance is when we ask for a price reduction because of an issue. We keep the inventory, but we ask for a price reduction. So these are basically, oh, the other thing that would affect this account is sale of inventory will reduce the account. So you have 1, 2, 3, 4, 5 transactions so far that affects the account. 2 of them increases it, the purchase price. So, and then the freight we pay if we are a buyer. So what would be the shipping terms if we're paying for the freight as a buyer? Do you guys remember what would be the shipping term? If you're a
FOB
Huh?
destination.
No, actually FOB shipping. If the contract asks for FOB shipping, then the buyer has to pay for the freight. So that's why we debit inventory. FOB destination, seller pays for the freight. Okay, so inventory being an asset. So far, you guys okay as far as all the transaction that affects this account?
Mm-hmm.
Okay, good. Now let's go over what I wanted to talk to you is screen share. There we go. Okay, so in this transaction, we purchased inventory on account, which, how do we know it's on account if they don't tell you on account? However, they give you the terms. A lot of time that's what's gonna happen. We don't say like this. We say Smart Touch purchased inventory of 35,000 and received inventory on June 3rd, terms 310, net 30. I haven't used the word on account, but the fact that I put the terms in here, it means we didn't pay cash. Why? Because we have created or established a relationship with the seller that means we're going to get a 3% discount if we pay what we owe him in 10 days after the purchase, after June 3rd. Otherwise, the net amount is due in 30 days. Therefore, this means we didn't pay cash. So if you do not see word paid, it means cash was not used. Make sense? Okay.
Mm-hmm.
So that was this transaction. Now the next transaction is, oh, by the way, this is in your handout that I gave you, and also in the PowerPoint slides. Everybody's okay?
Mm-hmm.
Okay. The next transaction is when we return some of the merchandise that we purchased, okay? Now, a lot of time we're not gonna say that the purchased was on account. What are we gonna do? For example, we're gonna say, Smart Touch returned 7,000 of June 3rd purchased on June 4th. And this area will go away. Now, you don't know if you're gonna get cash from the seller or the seller will reduce accounts payable. How would you know? You have to go back to June 3rd transaction to see, did we pay cash or did we put it on account? If we paid cash, then in here, we get cash from the seller. If we didn't pay cash, then we're gonna debit accounts payable. You guys are okay so far? Make sense?
Yeah.
Yeah.
Excellent. So sometimes you have to go back to original purchase transaction to find out what account you need to debit when there is a return. The credit always gonna go to merchandise inventory because that asset has gone back. Now guys, let's see, and this is explaining the difference between return. I've gone over these for you. Now, this transaction always causes questions for the students. Why do we debit inventory when the buyer, our company, is paying for the shipping cost. The reason is we want to really know how much money we have spent to get the inventory to our warehouse or a store. So the amount of money we spend is not only the purchase price, but also the shipping cost. If we don't include the shipping cost in the cost of inventory, then when we want to add a markup to it and sell it, we are shortchanging ourselves. Does this make sense?
Yep.
So the only time you debit merchandise inventory for shipping cost is when we are the buyer. So let's write that down in our whiteboard. And that is, you got to remember that one. Oh, this share screening. Okay, here we are, finally. So I'm gonna clear this. You guys, buyer debits merchandise inventory, or for short inventory, for payment of shipping cost. Okay, and then whereas a seller debits freight out account when seller pays for shipping cost. Do you see the difference between the two accounts? This inventory is an asset, so we're increasing the cost of the asset when we are the buyer and we pay for the shipping cost. When we become a seller, because once we finish buying, we're going to turn it around and sell it. When we are a seller and we pay for the shipping cost because we want to keep our customer happy, then it will go to an expense account called freight out. So you may want to add to it that freight out is an expense account. Okay, and it's what type of expense? It's a selling expense. It is a selling expense, or it is also categorized as operating expense. So operating expenses are any expense that the company has to incur except cost of goods sold. Operating expenses are all companies' expenses except cost of goods sold. Cost of goods sold is the cost of inventory that the company purchased and sold. So far, you guys are okay?
Mm-hmm.
Yep.
Thank you, Nick. So if you're done with this screen, then I'm go back. Is this enough time to write stuff? I have a feeling that the white screen is going to be taped in our session, so you have access to it. Whiteboard. Now, let's go back. Oh, I have to stop sharing that screen, otherwise you cannot see the other one. So We still are reviewing. These things should make sense. Now, we already gone over these terms before. Anybody doesn't remember the purchase discount or credit terms that they want me to explain it one more time? Okay. Okay, so you guys are okay. And then, okay, this is the compound entry. Somebody was asking me, when would we have a compound entry? When we have to pay for inventory that we purchased within a discount period, within the discount period, meaning we're gonna take advantage of the discount. So if the credit terms for this transaction was 310, and we bought it on June 3rd plus 10 days is June 13. So if we pay even on June 13, we can take advantage of this 3% discount. So 3% of what? 3% of what we owe, which is the purchase amount minus any returns minus any allowance. If you remember, we returned $7,000 of this $35,000. So we only owe what? $28,000. 35,000 minus 7,000 return is 28,000. Therefore, we can take discount on the 28,000 that we owe. So this 840 is calculated by taking 28,000 times 3%. Now, why don't we call it discount? Why does the cost of inventory go down when we take a purchase discount? It's because the same concept. We want to know the true cost of our inventory. So the true cost of inventory, if you want to know, is this sharing thing is, so cost of inventory equals purchase price minus returns minus allowances minus discounts taken on the purchase plus shipping cost paid on the purchase. Does this make sense, guys? So when we want to know what is the cost of our inventory, it doesn't include only the purchase price. It includes the shipping cost, but we have to reduce it by the discount that we took. We want to know truly how much cash we have to spend, cash spent getting the inventory to our company. How are you guys doing so far?
All good.
Yeah, good.
Excellent, thank you. So the transaction that you saw is purchase of the inventory, return of the inventory, paying for shipping, taking a discount when we pay for the inventory. So let's go over an example then, so you can practice what we just learned. And that is in your handout. Where is your handout in here? Guys, can you see this screen?
Yeah, I can.
You can see the first, it says accounting for merchandise operation and has
Yeah.
Yes.
typed on your handout.
Mhm.
Okay, excellent. So let's go to page, oopsie. First of all, if you look at page 11 of your handout, not 11, I'm sorry, not 11. Page, do you guys have your handout with you?
Yes.
Yes.
Okay, great. If you look at page 7, you see all the transactions that a buyer has, meaning that it shows when the company purchased inventory, they debit inventory, credit, either cash or accounts payable, depending on whether there was credit terms or it said paid. Returns, freight cost, payment within the discount period. Now, guys, when we want to do payment for inventory and we want to take advantage of the discount, I encourage you to go through these steps that I've written in here. Otherwise, you might forget that there was some return or allowance. So the first thing you're going to do is, how much did we buy? In our case, remember we bought $35,000 in that PowerPoint slide. Did we have any return or allowance? Yes, we had a return of $7,000. And the third question is, are we paying within the discount period? And if we are, then we're going to take advantage of the discount, not multiplying the discount by the original purchase price, but what we owe. Okay, so having this in front of you, and by the way, the note at the bottom tells you that you cannot take a discount on shipping cost. The discount is only on the purchase price minus returns and allowances. So use this page 7, and work on the next couple of transactions on page 8. There are 5 transactions on page 8.